Hello, and welcome to today's Lunch and Learn. My name is John Shirley. I'm the Vice President of the Vendor Program. We do a lot of things. Not only do we bring vendors into the vendor program to meet your real estate investment needs, but we also host vendor classes such as this to help further your education in your real estate journey. Today's presentation is brought to you by Catalyst Funding. They are going to be covering the DSCR, or otherwise known as a debt service coverage ratio, for this particular Lunch and Learn. And right now, I'd like to introduce you to our presenters. We have Wade Como and Ernest Powell. Gentlemen, go ahead and introduce yourselves and tell them a little bit about yourself.
Thanks, John. First, I want to say we really appreciate the opportunity to present today. Lifestyles Unlimited is a very important relationship for us, and we're really impressed by how many people in our local community and borrowers of ours have made a total difference in their financial future, created generational wealth by following the Lifestyles platform. We really built our company around that Lifestyles platform and try to provide products and services that could really help people change their financial future through real estate. So greatly appreciate the opportunity. Ernest, you want to tell them a little bit about yourself?
Oh yeah, so my name is Ernest. I am the Houston sales manager for Catalyst. Been with the company for about 3 years. Just echoing what Wade said, we're excited to speak about this DSCR presentation. It's a very hot product right now. I believe the information we received while you guys. So I'm looking forward to sharing it with you guys.
Absolutely. Next slide, please. Great. So we're going to cover our value proposition. So we work really hard to be a one-stop shop for hard money and permanent financing loans. So hard money is the money to purchase and repair distressed real estate. We're specialists in this particular category. Then we also offer a wide variety of permanent financing loans, including conventional loans, and then what we're talking about today, which are debt service coverage ratio loans or no income doc loans. We're going to deep dive those throughout this presentation. We're also real estate lenders built by real estate investors. Many of our employees are investing in real estate. And then I also own a pretty large single family portfolio as well. So between all of the people on our team and myself, we've made a lot of mistakes over the years and had some successes, and we try to bring those to you so you can help avoid the mistakes and increase your profitability and happiness overall. We've been involved in thousands of transactions over the years, and we have a single point of contact model, which means with one loan officer and one credit pool, you can get that hard money and the permanent financing loan, really smoothing the process out and making it a lot easier for our borrowers, which are often pretty busy in their personal lives and their business lives. This just really makes it a lot more efficient. We have 5-star customer service reviews on all the social media platforms like Google and Facebook, as well as the Lifestyles Unlimited platform. And then we cover the products that we have here: hard money, conventional, non-conventional. We also can offer primary refi, purchase, and cash out if you're needing that. And a lot of people, even though rates are a little bit higher, we'll cover this later, are doing cash outs at the moment, either on their portfolios or on their primary residences, to take advantage of what's an incredible market right now for single family investors. It's not a part of the presentation, but I will mention it. The average investor before rates went up was paying about 90% of after repairs value. Right now they're paying about 72.5. So on our average transaction, investors are getting about 50,000 extra in equity capture than before when rates were so low. And savvy investors are out there making deals right happen, because you don't have to marry the interest rate. You only have to marry the purchase price. You can never change your purchase price, but savvy investors are taking advantage of the fact that they can always refi the interest rate at a later date and are getting fantastic deals at the moment. Last thing we'll cover here, and we cover it in the rest of the presentation, we do have non-QM loans as low as a 620 FICO. That's a DSCR loan, kind of what we're talking about right now. And if maybe you or someone you know has not been able to find a solution to get into the real estate investing long-term buy and hold game, this can be an excellent product for people that may be credit challenged. And then we'll go to the next slide.
All right, so I'll cover this slide. This is kind of give you guys a preview we're going to cover today. So we'll deep dive what is a DSCR loan. We'll give you guys the formula for the DSCR. They will also provide an example so you can see hard numbers for it. We'll go in detail about the loan basics, what's needed for DSCR loan, what their important requirements are. We'll talk about the pros and cons, and we're comparing it to a conventional loan so you can see the difference between those. Those are more popular products. We'll discuss the turn time for those loans. our appraisal process, what that looks like. We will provide a case study so you can see someone going into a hard money loan and then refinance out of that hard money into a long-term loan. And at the very end, we'll give you a cash out of nothing. So just give you an example, if you have a primary residence or investment properties, if you were to cash out right now, what that looks like as far as increasing your overall net worth. So we'll deep dive that for you guys. And so now's the time, like Wade mentioned earlier, the market is not competitive as it was a year or so ago. So our savvy investors are buying properties right now and getting those deals at that 72%. So that's a big difference from last year at the 80 to 90%. Next slide.
Okay, first we'll start off with exactly what a debt service coverage ratio loan is. It is a business purpose loan. So this cannot be used for owner occupied properties, right? It is designed for people who are investors and want to be landlords. Many borrowers are often entities such as LLCs, and these are non-TRID, non-QM, non-RESPA, non-Dodd-Frank, true commercial loans. So these are all regulations which were put in place after the great financial crisis to protect primary homeowners. So none of these things apply to these loans because they're true commercial business purpose loans. Borrowers are not limited by the 10 GSE property limit. So that is a big thing. If you're looking at Fannie or Freddie loans, each individual borrower will cap out at 10 GSE property per borrower. So you can get to potentially 19 if you got a husband and wife team or partner team. And then we also have clients that have financed over 50 individual properties with us. So we have one borrower who refinanced like 69 properties. A lot of others were in high numbers as well. So you can take advantage of this product without the limits that are provided in other product categories. Next slide, please.
All right, so in this slide, we're going to discuss what DSCR is. DSCR stands for debt service coverage ratio. So you can see it's a pretty simple formula. You would use the lease or the 1007. It's the lesser of the two, and you would divide that by principal, interest, taxes, insurance. Then if you have HOA, you add on there as well. With the lease or 1007, it's the lesser of the two. We do have some products that will allow you to use the lease if it's a higher amount if you collected that lease for more than 3 months. So there is some different guidelines for different products, but that's the overall formula for it. And so the next slide, we'll give some numbers to plug in so you can kind of see the difference. Next slide. All right, so in this example, we're plugging numbers in. So we're saying the lease are 1007, so let's take a lesser of the two. Let's say it's 1500. And then if you have your principal and interest at 798, taxes at 300, monthly insurance, which is HOI at 150, and if you have HOI on this property 30, that totals about 1278 on the bottom number. So if you divide 1500 by the 1278, it gives you a 1.17 DSCR. So it's basically showing this property is cash flowing on a monthly basis. It's not getting negative cash flow. Am I asking for that way?
Yeah, before we move to the next slide, if it's okay, I was going to cover one other thing here. 1007, for those who do not know, is the appraised rent rate. So it's a particular product that an appraiser will provide for these types of loans, or if you're doing a conventional refi, a 1007 will be provided as well. And it's really built in the same way that a traditional home value appraisal is built, in that there are comparable cells that are collected, and they pick the 3 to 4 best comparable cells, basically take the average of what those properties with adjustments comp out at and show what the projected rent rate will be. And as Ernest mentioned, you do take the lesser of those two. With the lease, it cannot only be a signed lease. There's often some other monetary proof that must be collected in order to ensure that that is not a fraudulent or maybe even a temporary lease. They do want to ensure, if they're going to go above what the 1007 says, that there's hard evidence that that lease agreement is valid. So keep that in mind as well.
And I'll add something to think about it. The reason they use the lesser of the two, because at times you may be able to get a lease that is higher than what the average market rate is. So you may be able to get a lease that is 2,500, whereas the average in that market may be 17. They're basing this loan off a 30-year fixed loan. So they want to make sure whatever number they're using to verify the cash flow is something that can be sustained over a 30-year time frame. The lease you may have maybe only 12 months. So that's why they take the lesser of the two to kind of average it out for you.
It's a great point, Ernest.
We can go next slide.
So we're going to cover some DSCR loan basics here. So the typical LTV for a purchase transaction is 75 to 80%. We do have products at Catalyst which can go up to 80% for that purchase transaction. Typical LTV on a cash out is between 70 and 75. We do have products on the high side there at 75. There are not very many 620 options. As I understand it, we may have one of the only 620 options that are out there. Normally, the minimum FICO is more in a 660 or 680 range for this particular product. So if you have worked with some other lenders and we're not able to get qualified, I would definitely encourage you to reach out to our team in order to talk about that. But more often than not, you're going to want to be in that 660 to 680 range to have the broadest number of options and to get the best possible pricing. That's when you're going to get into a better place. And then, of course, like all other products, if you're in a 720 or 760, you get even better LTVs and pricing at those levels. So the typical range of debt service coverage ratio expectations are between like a 0.65 and a 1.3. If you're on the lower end of that range, you're often going to see a reduced LTV, maybe as low as 65%, possibly 70. We do have a DSCR product that does not require a debt service coverage ratio. That LTV is currently 70%. That can sometimes be fluid, but as of filming this today, April 4th, 2023, we do have a 70% option with no DSCR. So if you get into a situation where maybe the appraisal comes in low, or you need to work, maybe the rents were not as high as you anticipated and you're needing to have an exit strategy, that can be a good product in that circumstance. Another great thing is that they are 30-year loan terms. Some of them are fixed. Right now, the ARMs are not more attractive because the inverted yield curve. So the ARM rates are not that much more attractive. So you can get a good 30-year fix. There are some interest-only options as well. That's not always encouraged by LU mentors, but I guess there could be some special circumstances if you're on a shorter term hold that might be viable. Most instances, we know the game plan is to hold for 5 years and either refi or cash out. So those interest only may not be the best options in some circumstances. And then you also have to have verified reserves. That's often 3 to 9 months of verified reserves. That's 3 to 9 months of PITI payments. And then also you might need to have plus 1% of all mortgages showing on your credit bureau. So there's a couple different ways to calculate it, but those are the most common ways in which the lender is going to ensure you have adequate reserves to weather the storm if you have vacancy or unexpected repairs. Next slide, please. I'm sorry, that's still me. I thought I was turning the baton over to Ernest. Okay, so a few more basics here. 30-year fixed rates available and ARMs available. We discussed that briefly. You do have a few different no income doc requirements in this asset requirement, which we covered on the other page. I do want to cover a little bit about the number of units that are available. There may be some higher unit options that you can review if you wanted to discuss that with your lender. And then we did cover the FICO score as low as 620 earlier, but that is very pivotal. There are a lot of competitors which may not have that. And if you get into a spot where your FICO drops, or if you know an LU member or someone else who may need help their FICO dipped outside of the range where they qualify for a DSCR product, that's definitely important to know. And turn it over to Ernest here.
Next slide. Okay, so talking about some of the requirements for a DSCR loan. One of the good things, you will not have as much documentation to provide as though you're doing a conventional loan. So that's one of the positives about it. But some of the key factors: the property must be leased, and there is some tricky things about the lease. It needs to be a long-term lease, so we don't do short-term leases. It has to be at least 6 to 12-month lease in place. One of the other things is it has to have proof of occupancy. The way we verify it is when the property is appraised, the appraiser will go out and take pictures of the property inside and outside. The pictures from inside will allow us to verify that someone actually lives in the property. So you're looking for furniture, just showing the property is living in pretty much. So that's how we verify occupancy. These loans do have prepayment penalties. Most of them have a 5-year prepayment penalty, so it's like a 5-year step down. What that looks like is the first year, if you were to pay it off early, you pay 5% of principal balance. Second year, you pay 4%. Third year, you pay 3%, and so on. We do have some options to where you can buy out of that prepayment penalty. And one of the options will allow you is the difference of a quarter on the interest rate to go from a 5-year to a 1 year, which is really good. So I kind of explained earlier, you have about 3 to 4 outlets for these DSCR loans. All of them have different guidelines. So we'll talk in detail later on about which one works for each scenario, but it has a wide range of options for you.
Yeah, and that's a good point before we move on the buy downs. As he mentioned, like oftentimes in these circumstances, if you pay it off early in year 5, you might have a 5% prepayment penalty with some of these options. Then when you get to year 1, it could potentially only be 1%. So in an environment where we think rates could go down relatively significantly in the next few years, really looking at your buy down options is critical. I would think trying to find one where you do have the ability to buy out of that is pretty important. You'd want to talk with your mentor, also talk with your loan officer based on your own individual hold period and expectations, but that can be a good option to have some flexibility in case rates do drop relatively significantly. So on this next slide, we're really trying to compare the pros and the cons between what loans you may be more familiar with, which are conventional loans. That's what we're really going to deep dive over these next few pages. So in conventional loans, you are not able to borrow in an entity. Now there are some ways in which you might be able to reverse things after closing, potentially with a Fannie Freddie deal, but at the end of the day, you cannot close in an LLC and certainly not in a non-irrevocable trust on conventional loans. But you can use those two vehicles with DSCR loans, which gives you a lot of protection. You know, Lifestyles Unlimited does a great job of protecting. There are other ways in which you can protect your real estate investment assets if you do conventional loans and borrow in your name, such as umbrella policies and insurance structures. But this can also be an important part of your toolkit to protect your assets. Ernest, go ahead.
I was going to make mention too, for the loans that we close in your LLC, with some of the products we have, with it being in your LLC, it won't report to your credit report as an active trade line. So that is good too if you're trying to keep your investment world separate from your personal finances. That is a good option to take as well.
Absolutely. And there are some ways in which these products may also not count against MERS and limit your number of Fannie Freddie transactions. There may be some ways in which to do that with certain lenders as well. There are far fewer ways in which the loan can be denied. So conventional loans, while they offer the best pricing, there are a lot of hurdles that you have to jump over. You know, of course, the easiest one to get denied on would be income. You have to provide full income documentation. You know, you have to provide W-2s. You have to provide tax returns. You may have written off things in your business or in a side business, a side hustle that you might have. You might have written off a lot of things on your rental properties that you already own. There's a lot of ways in which you could be denied. There are also other rules which are not built by the lenders themselves, but built by Fannie Freddie that may seem difficult to understand. There are fewer of those things with DSCR loans. It's really just determining if the property can sustain the mortgage payments. It's not determining so much if you can sustain the mortgage payments. That's where the big differentiator is. Easier process with far fewer documentation requirements. So you're not going to have to gather up, as I mentioned earlier, all your previous 2 or 3 years tax returns. You're not going to have extensions for taxes if you're at that point of the year. You're not going to have as many bank statements in many instances, although you are going to have to verify some assets for reserves, but far fewer overall documentation requirements. Turn times can be faster with some lenders. I will say that there are a lot of DSCR lenders that have very, very slow turn times. I've heard borrowers come to us and say sometimes they take 60 to 90 days. So that's something you definitely want to ask about and understand. Look at a lot of online, survey reviews and overall reviews to see what the turn times are, but there can be faster in some instances because you don't have to collect as many documents. You don't have to get as many third-party verifications. Like sometimes verifications of employment, other things like that can really slow the process down, and you don't have those here. Do you have a comment there, Ernest?
Yeah, I was going to say, one of the big things with conventional loans too, if you have multiple properties, you have to provide documentation like taxes, insurance for those properties as well to verify your income. Whereas on these products, we're only focused on the subject property. So that is a huge time saver as well.
Yeah, lots of ways in which the process can go smoother and easier. And smaller loan sizes are also more viable. You know, with some of our products, it can get as low as I think maybe 55 or 65K. I can't remember. I think we're going to cover that in a moment. But it's often very difficult because of a few different requirements based on overall fees that the Fannie Freddie has to get loan amounts that low. It's not that they have a hard minimum, but by the time you price everything in, a lot of times you can't get loans that low if you're looking at a conventional exit strategy. All right, next slide, please. Some other exciting things about this. One is rapid scalability. At the end of the day, all quality investments can be financed if you have minimal asset requirements. Like the asset requirements we were covering earlier really aren't that significant. And you know, this is a great way for people who have good credit and enough money to purchase in the Lifestyles Unlimited model, where sometimes you're only out of pocket. You know, we've seen some amazing deals recently in the current environment. Maybe people are only out of pocket $5,000, $10,000. On average, it's going to be more than that. Don't get me wrong, 15 or 20. But if you have the assets with which to do that, you do not have to cover, you know, the payments with your primary jobs, with your W-2 or your business. Now, really on a conventional side, as long as you cash flow, you don't have to do that either. But there are some other requirements as you have more in the reserves. You have to really start stacking up more and more reserves as you get into the higher number of loans. Many investors expense rental property repair costs rather than depreciating them. This is a really big one. And we always tell people whenever they first come to us, we try to be trusted advisors in this particular area because it's where some people do make mistakes, is if you expense everything, whenever you come to qualify for loans in the following year when you have to provide your tax returns, you can have huge losses in your rental portfolio to try and offset with your primary income, like your W-2 income or your primary business. And that can be very, very difficult to overcome. So you had two options at that point. One, you could potentially not file in that way. Well, three options. You don't file that way to start. You could potentially appeal your tax returns after filed once we realize what's happened. Or you could go with one of these DSCR loan options where you don't have to provide your tax returns and no one is aware of the losses that you may have written off. So that does give you a wide variety of options if you're willing to entertain the DSCR loans. DSCR loans can be a challenge when I'm sorry, that topic, I'm getting off kilter here. That can be a real challenge when doing conventional loans, as I mentioned earlier, writing off a lot of things, a lot of expenses, not a problem with DSCR loans. And then often surveys are not required if the property is not meets and bounds. If it's in like a subdivision, you may not have to get a survey. Conventional loans do require surveys. And then bulk purchases and refinances are often available as well. So sometimes Lifestyles members may sell, you know, 8 properties at once or 12 properties at once or even more in a portfolio. And there are ways in which to purchase those properties with DSCR loans in bulk that can be more attractive to the seller. And they also consider this to be a type of loan where approval is more likely. So they may consider this a more attractive offer if you're going to use a DSCR loan product than a conventional loan product. All right. Anything to add there before we move on, Ernest?
Nope, that was good. All right, so I will discuss some of the cons of a DSCR loan. So the rents must cover the DSCR. So you do have a little more flexibility with conventional, which pretty much means if you have a property that's not producing as much income on the rental side, if you have personal income that will be able to sustain it, you can use that. So that's where that more flexibility comes in at. A lower appraisal value and rent rate can impact the loan amount. So if you go into a deal thinking it's going to appraise for $200,000 and the rental comps are going to be I don't know, 1,800, and it comes back in the 1,500, that does impact your DSCR directly. We do have some creative ways when that happens to offset that. One is by lowering loan amount, which will in turn lower your P&I payment. And also we can shop around for different insurance. We have several insurance partners we work with that are familiar with the product and can get us the best insurance possible at a lower cost at times. And so getting the lower insurance could impact the monthly payments on insurance, which would impact the DSCR too. So we have some ways to offset it, but that is something that could come up at times. Prepayment penalties, we talked about that earlier. Conventional does not have prepayment penalties, whereas DSCR loans do have them. Like I said, we have those options to get a lower prepayment penalty in 1 year as opposed to 5 years. Most of these loans do require the payment to be set up on auto draft. So ACH is required at closing to auto draft those payments. All of them have escrow required. So conventional, you can do without escrow, whereas on these loans, there's more risk involved with them because there's no income docs. So they do require escrow to be set up at the time of closing. And all these loans do have origination points associated with them. Origination points are typically like 3 to 4, whereas on the conventional side, there is no origination points. They do have discount points associated with the rates themselves, but there's no hardcore origination points that's associated with the loan. So currently right now on conventional, we don't have a par rate. So there are discount points with every loan, but a year or two back, there were some loans that were at the par rate. We didn't pay any discount points on it. So that's a huge difference in those two. Anything you want to add, Wade, if we move on to the next one?
No, I think on average, the pricing is a little bit higher, which is understandable because you're not fully documenting the loan. They don't understand your full income capability. And you know, on a conventional loan, if you think about it, there's really 2 ways in which you should be able to make the payments, which are kind of verified. 1, the ability to collect rents, and then 2, your own personal ability to pay. On these loans, there is no evaluation of your personal ability to pay through a W-2 or alternative business. So it does make sense that the pricing might be a little bit higher, although the spreads are smaller than they've been in the past. And there are some decisions the federal government has made to add what are called loan level price adjustments on non-owner occupied loans, which have increased the pricing. And the gap is far more narrow than I recall in the past. So it's becoming a more and more viable option for people who even qualify for conventional loans to potentially use these as an earlier option or as a first option for some people. So next we want to talk about the appraisal process, and a big driver in appraisal process timeframes are the ways in which the appraisals are structured. So actually, if we could, I think there may be one slide back. Yeah, perfect. So the turn times can be faster because of the appraisal process. In general, if you have a lender who has, there's a couple different options, which we'll cover on the next slide. But if you have more flexibility, we do have the ability internally to close in under 30 days in core metros across the country. Those are areas where you know there are more appraisers and the expectations for turn times are quicker. Could be under 45 days for non-core areas. That's more rural areas where there are fewer appraisers and not as high of an expectation for quick turn times. So a couple other advantages: there are less rigid automated review processes than there are in conventional loans for appraisers. Like on a conventional loans, there are some very rigid processes that sometimes disqualify appraisals, especially in more rural areas or areas where comparable sales are difficult to find. So that's one attractive thing. But then it's very important when speaking with your lender. There are a lot of good DSCR lenders that are on the Lifestyles Unlimited platform, that you understand the way in which the appraisal process is handled. So option 1 is that potentially the DSCR lender can order appraisals directly from the appraiser. That is the most attractive. That is the option at the bottom, the direct order option, most flexible, also quicker. You can reach out to appraisers, negotiate with them, try to figure out if they can get the appraisals in as quickly as possible. And then it's also easier to select appraisers who really understand the real estate investment game. That impacts value. We're very dedicated to always having fair and ethical values, and we want to have the highest ethical value for our borrowers. If you work with appraisers who really understand real estate investment, they are less likely to panic with the value that you have created on your investment. What I mean by that is appraisers can often only see the purchase price associated with the appraisal. And they do not see something like assignment fees, which could be a part of deals that are presented to you by a Lifestyles Unlimited agent. And so sometimes it's really confusing, and sometimes it makes an appraiser lower the value despite the comparable sales, because they're worried, like, how did somebody buy this house for 100 and it's worth 200 3 months later? Savvy and experienced appraisers that understand this business understand the value played, that there could be, there could be assignment fees, there could have been a double close associated with the transaction, there could have been a value play where you made a lot of improvements on the property, and they will ask what improvements were made. Those are the appraisers that we want to work with. And whenever we have the direct order flexibility, we can definitely do that every time. In addition to that, the next best option is the AMC with panels. At minimum, we were able to work with AMCs with panels in all the areas in which we do business regularly, which means that you're going to still be able to select those individuals, but it may take a little bit longer because you can't reach out to them directly regarding the turn time, and you're going through a third party. The other option is AMC with no panels, which means it's the broadest array of appraisers, and many of them do not have experience in the real estate investment space. That's where turn times could be elongated and maybe values could be lowered. So you definitely want to speak with your lender and understand the way in which they go through the process. I do want to explain the acronym before we move on. AMC means Appraisal Management Company. So this means that there's a third party involved that is not directly with the lender. Now, there are some advantages to that, to making sure that these things are always handled in a very ethical and compliant way. Some lenders are able to handle that internally and have their own internal appraisal management group to ensure that this is also handled in an ethical way. And those lenders are going to have a little bit more flexibility to ensure the process is smooth, quick, and that you get the highest ethical value. Anything to add to that, Ernest, before we move on?
Oh.
Perfect. Next slide.
Okay, so we're going to do a real quick case study just kind of showing you someone who purchased a hard money loan, finished a rehab, and then refinanced into a DSCR loan. This is a live case. We just closed on these two loans maybe 2 months ago, maybe. So let's give you the quick numbers. This particular person on the hard money side had an ARV of $256,000. We blend based off the ARVs, so we can go up to 75% of that. So that's $192,000. Their purchase price was $149,000. Repair budget was $34,000. They had earnest money in the deal, $2,500. So give them credit for that. They needed $180,000 and change to buy it and fix it up. So because we can go up to $192,000 and they only need $180,000, the only thing they really bring into closing will be their closing costs. Their closing costs in this example is about $10,000 and change. So right now they're all in at about 70% of the LTV. We roll the closing costs in, it puts them at about 73%. So they go up to $189,400. So you see they're up. You see the rates 11.74 and 2.5. So at the bottom you kind of see the breakdown of the closing costs where we get $10,000 from, but they're all in. At the end of the day, cash to close is about $1,741 at the very bottom. That's just for the hard money deal to get them under contract, purchase a property, and start rehabbing it. So $1,741 for that first deal on the hard money. Then if we go, and so we mentioned this earlier. Like I said, I was nervous about presenting this one, but these are the deals we're seeing right now. Like people are at that 70 to 73% range, and we didn't see that over a year ago. So this is the time to be in the market because you're getting these deals with close to nothing out of pocket. So we go to the next slide. We'll show you the DSCR loan estimate. All right, so on the next one, this is the DSCR. So we're refinancing that hard money loan. We finished the rehab. The property is leased out at this point. So we're assuming the appraised value came in at $259 on this side. We came in like $3,000 higher. Our loan amount going up to 75% of that would be $194,250. The rate is pretty good at 7.125. That is the same thing we're seeing right now on the commission side as far as rate. So, and then 360. So pretty much they have the closing costs, but so you can see everything added. They are out of pocket about $7,600 on this deal. So adding the $7,600 and the 17 from the hard money, roughly about 85, less than 9,000 out of pocket for a deal. I think it's cash on them roughly about $300 a month, $300 to $400. So that's a good deal, and he was able to get in and out of it pretty quickly. So that's the case as you guys see the number breakdown of what customers bringing the close on it. You want to add to this, Wade?
Only thing that I was going to mention is that back of the napkin looks like about 64,000 in equity capture at close for being under 10,000 out of pocket. That's not an uncommon deal that we're seeing at the moment. Not that everyone's like that. Oftentimes they're a little bit outside of the major metros, or maybe not in what some people might consider the highest appreciation market. If you're in one of those premier excellent suburbs with fantastic school districts, you're probably going to pay a little bit more than this, but they're very incredible opportunities at the moment to get that much equity capture for being under 10K out of pocket. So that's this is not every example, but it is a good example so you can see what's going on and see how the DSCR loan works.
And I mentioned too, so like I said, the DSCR origination points range anywhere from 2.5 to about 4. This particular customer I know personally has about 3 or 4 deals in the pipeline at once. So of course they got a lower origination point, but that's the only thing that really changed the price on this.
Yep, good point. Okay, next slide, please. So we're at a point where we have about 6 minutes before questions. So I have 4 slides here. I'm going to deep dive 2 of the slides and not really cover the other unless it comes up in our questions. But this is a scenario where you could take cash out either from one of your non-owner occupied properties or from your primary residence or second home. And it gives a good example of the impact of taking that money and investing it in the lifestyles model, in single family properties, and how it will impact your overall net worth and cash flow. So a lot of people in the market right now and the lifestyles members may not have as much money as they would like to take advantage of the market that is there today. So one option is potentially taking cash out. And a lot of people do get concerned and ask questions about their primary interest rate. So this is an example where the current interest rate is an example of a primary mortgage being at 3.5%. This could also be a non-owner occupied property where you're looking at doing a conventional or a DSCR loan in order to get cash out of that. So it's applicable to both non-owner occupied and owner occupied, although your non-owner occupied rate would probably be a good bit higher than 3.5. So here are the assumptions. Starting in the top right corner, property appreciation rate of 4.5%. This is lower than the historical average, but we wanted to be conservative. Current home value, $400K. Current amount owed on the next box over, $200,000. So $200,000 in equity. Current interest rate, 3.5. Original loan term is 30 years. Original loan amount, $250,000. And years remaining on current loan, 21. So if the person did nothing, they just said, I'm going to hold on to this property and have my net worth increase by paying down the mortgage, I would end up with a net worth of 1.5 million, approximately. The other scenario is cashing out and investing this into properties, right? So we're estimating the max cash flow per property at 250, which honestly in the current interest rate environment is not uncommon to be lower than it was before. As we mentioned earlier, the good news is you're not locked into that cash flow forever, but you do get that massive equity capture because some people are wanting to have cash flows like they had whenever rates were far lower, and it might be closer to 300, 400, something like that. So the term of the new rental loan would be 30 years. The out-of-pocket for property, we estimated 26.8, which is actually on the high side of current estimates, far lower than the example we gave a few moments ago. The ARV of the new property, 275, very common in this market, especially in Texas and some of the other markets where Lifestyles encourages you to invest. The rent rate appreciation, 2.25. That's actually very conservative. We actually cut that rent rate appreciation in half in the property appreciation rate. Normally they move more in concert, but again, we wanted to be conservative. An assumed property appreciation rate of 4.5, and then the interest rate on the refinance loan being 6.5. So that's the thing to keep in mind. Are you willing to go from 3.5 on the current interest rate to 6.5, right? If you are, you get the benefits below. Monthly net cash flow from new properties purchased at closing is $1,000. Monthly cash flow for new properties at investment time horizon, only assuming a 2.25 rent rate appreciation, $8,000. Now that's if you held it to 30 years. We're trying to give a long-term example. We know the lifestyles model is not to do that, but to rather refinance every 5 years, which would only put these numbers on steroids, either refi or cash out every 5 years. These numbers would be exponentially greater if you were doing that. This is a worst case scenario if you only held the properties originally purchased. Moving on further, overall cash flow over the entire time horizon, 1.5 million, which basically makes up the entire amount you would have made on your primary residence. And then the value of homes at the time horizon, 4.1 million. The total net worth at the end, 7.1 million, for a variance of 5.6 million. So that is a huge increase over doing nothing. And this means that you're increasing your rate. But you know, one thing that's interesting is the easiest dinner party or cocktail party conversation is for people to brag about the super low interest rate that they have on their primary mortgage. But really, as Dell says, that is dead equity. It's not doing anything for you. So we think this is a great example of how you can take advantage of DSCR loans or other products to do more, even though you're increasing your rate. If we could go 2 slides down, please, I'd really appreciate it. So this, we got 1 minute. I'm just going to hit the bottom line number here. This would be if you were only doing this on the 10-year scenario. So not holding it all the way to 30. This is every 10-year period. If you just held your property, your primary residence, or your non-owner occupied property and did nothing, you'd end up with like an extra 500. You'd end up with 500,000 in net worth at the end of that period. If you did this scenario and you went through and actually, you know, cashed out and invested in properties, your variance would be an extra 1 million in just a 10-year period. So if there are any questions on this, we do have some more in-depth slides that you could look at. And if anyone wants to reach out, we're also happy to provide this presentation so you can see the other 2 slides that provide more in-depth info. But with that said, I do want to turn it over to John again at this point so we can ask any questions or answer any questions from the group.
Okay, yeah, so excuse me. Do you offer any DSCR blanket or portfolio? One of these days I will learn English. Do you offer DSCR blanket or portfolio loans?
We do. I can take that question. So we do have a blanket/portfolio loan. That basically means that you can take several properties and put it under one loan. We do have a product now that is a 30-year fixed loan. It is treated the same as one of these DSCR type loans. The only difference in those, the DSCR has to be at 1.1 on those DSCR loans. You can have up to 20 units in that property. I'm trying to think what else you have in there. It's a big difference. And that's it, really. The rates on those range anywhere from 6.99 to about 8.5%. So still really good rates, very comparable to what you would get on your single family type loans. But it makes it easy to where if you have a larger portfolio, you can manage them all in one payment, one escrow payment. Like it's a lot easier process than having 10 plus properties separated with different companies. So there's definitely an option we can talk about in more detail that we have available as well.
I might add one thing real quick, John. That is one of the more fluid categories of DSCR loans. We've seen that product maybe go away at times, and so we didn't really put it in the presentation. At the moment, we have it available, but as we mentioned earlier, we're recording this on April of 2023, so you do want to reach out to your lenders and see what the market is doing whenever you're looking to do one of these transactions. It could be very different a year from now, or even 6 months from now, or even sooner. So just always check with your lenders to see what options are available. And if your current lender says that they may not have it, you may want to check with someone else because someone else may be able to offer it at that time.
Okay, so now I've got an important question that goes along with the blanket loans that we run into quite a bit with certain lenders, with various lenders. And the question is there a partial release rule on blanket loans? Can I sell one property out of it, and what kind of penalties are there involved with that?
So I can answer that too. So piggyback on what Wade said, it's a very fluid product. So at one point in time, we had one that had a partial release that you can do. This particular one right now we have, it's a 2-part. One portion of it that's a little bit easier to qualify for, does not have a partial release, so you cannot sell one of the properties out of it. And then there's another portion, another version of their product is more so geared towards like a 5 or 7 to 10 year payment with balloons at the end. That one does have partial release, but that one does require more documentation to get approved. So this kind of depends on which route you go on that option.
Okay.
I think it's an important question to always ask. You should be able to be provided the release provisions in advance so that you understand them. Sometimes it's still worth all the convenience. Sometimes you may consider the terms too onerous to want to move forward with it. So that's one thing you do want to ask very early in the process so you know what you're getting into.
Now, the next question is where or what states do you offer loans in? Now, I know you guys pay for marketing in certain states with us, but for those members that are in other states outside of Texas, where all do you guys cover?
You want to take that one, Ernest?
Yep. For the DSCR, you don't necessarily have to be licensed to do those loans, so we can cover pretty much every. There's very few. I don't know off the top of my head, but it's like a handful, like 5 or 6 that we don't cover. But I would say that's a nationwide product that we can do DSCR loans in.
Okay.
So and then on conventional loans, you do have to be licensed, but we do have the ability to do those either in-house. We're licensed in a lot of the states, primarily the states that Lifestyles Unlimited operates in. We try to make sure we're licensed there. So states like Georgia or Florida, other states where Lifestyles has a big presence, we try to be licensed there. Tennessee. But on the hard money right now, we're primarily focused in the state of Texas. We do have some other options, but they're not as attractive and as fast as our Texas options are for hard money. But on DSCR and conventional, to Ernest's point, it's a much more of a national approach.
Okay. So I've got a question for you. You mentioned the 0.65 to 1.3 DSCR range. How does a 0.65 DSCR work? Doesn't that mean you'd be in negative cash flow?
It does. And some lenders are more flexible to go down to that level, but there are other factors involved, right? They're going to reduce the LTV. They may have some other requirements. It may require a higher FICO. We're trying to give the range across a wide variety of potential lenders and outlets, but yes, that would be what be considered a negative DSCR, and there are lenders that are comfortable doing that. And as we mentioned earlier, we do have one outlet that also allows no DSCR evaluation, but with a reduced LTV. So that could also be a good option if it turns out you went into a project expecting higher rents, you're not able to get that, and you're looking for an exit strategy. Either a lower DSCR requirement or a no DSCR requirement could be a viable option.
Okay, so now I've got another one. We always talk about building a portfolio, and you usually get each spouse gets 10 houses, etc. So this one leads into that. If someone takes a DSCR loan, will it affect them trying to get conventional loans in the near future, and does it affect the credit in that direction?
Ernest, do you want to take that?
Yeah. So it depends on which company you go with. So some of those DSCR loans do not report to your credit report. So I know one of the ones we use for sure does not report to the credit. And so if you were to go do a conventional loan afterwards, if you have many LU borrowers do, that loan does not pop up anywhere as a liability for them. There's some other outlets that will report to the credit. So that's like that's a very important question to ask up front. How does their credit report work on it? And then the other question is, does it impact your ability to get more conventional loans? No, as long as you not pass your 10 conventional loans on that side of the house already.
Okay, now do individuals qualify for the DSCR, or does it have to be an LLC?
You can put the loan in a LLC or individual name, but the individual will be the personal guarantor of the loan. So we'll use individual's credit score, we'll use their personal finances to verify they are qualified for it, and then the property itself will verify if it cash flows or not. But so the property will be deeded into, if it's an LLC, to the LLC. The promissory note would be to the actual guarantor.
Okay.
So that's if the question was to add to that, you're not able to avoid personal liability with these loans. Even if you put in an LLC, you are going to have a personal guarantee. So it's not like the LLC you create would be the only liable party, if that makes sense.
Yes, it does. Okay, I had another question I was looking at, and I scrolled down, and now I can't find it. And so how does this work with commercial property? So we've got a lot of folks that, well, let's just say there's folks that want to buy multifamily, and so they're looking at doing that, but they're also, we'll just leave it at that. We've got people that are interested in commercial property, whether it's multifamily. I believe it, we do have some that we don't teach this, folks. So just as a little side note, talking about storage units, things like that outside of the LU model. How does the DSCR loan, I know it's a commercial product originally, does it cover those items? And what does it cover?
Yeah, so the term commercial has multiple meanings, right? In these particular, with these particular loans in this particular setting, commercial does not mean what some people, maybe this particular individual thinks of, like public storage or strip centers or things of that sort. For these particular products, commercial just means that it is a business purpose loan and is not an owner occupied loan. So it is not for a primary residence. This product is not available for strip centers or public storage facilities or anything like that. You can have small multi-family that qualifies for this product. Like if you want to do an IRO and it's a 8 unit or 16 unit or something like that, that is available. But it is definitely not available for the commercial properties. And we, if you guys wanted to talk about some commercial outlets, we can talk about that outside of this call. But as John said, really we're trying to stick with what the Lifestyles model is. That's what we really believe in and what we're teaching today. And that's really for, the commercial would be for single family 1 to 4, or potentially for small multifamily. Or then there would be another call with experts in the multifamily space that John and his team would be able to have with you.
How long does a borrower with a DSCR loan, how long do they need to wait to do a refinance?
They can do 3 months, 3-month seasoning period. Now, I say we have different outlets, all of them have different guidelines, but our quickest one is a 3-month seasoning period before you can refinance the property.
Okay. Can you go ahead? I'm sorry.
I was just going to clarify that real quick because they just said the term refinance. So I do want to make sure that would be like a hard money purchase or potentially a cash purchase to a refi. Now, correct me if I'm wrong, Ernest, to do the 3-month refi, you would have to do hard money because you can't do cash out in 3 months. Is that right? Or can you do cash out in 3 months? Okay.
Correct. You can't do that. Well, I'll take it back. There's one outlet that will allow you at the moment, you can, if you buy a property with cash, after 90 days of owner property seasoning, you could do a cash out at the 75% as is value. But that one is fluid too, and it changes. So it's something to keep in mind before you go into a deal.
I would personally encourage going with the Lifestyles model of purchasing with hard money and then refinancing, because that product, to Ernest's point, did disappear for a while. Another thing is that there are some new changes coming down from Fannie Freddie on conventional time frame to do a cash out if you purchase with cash, and either that is at 12 months or will soon be at 12 months. I can't remember exactly what it is. It's already at 12. Yeah. So and that momentum could move into DSCR as well. So that's why we really encourage going with the Lifestyles model, making the value play, keeping most of your cash available and using hard money for your purchase instead of using all your cash.
Cover a little bit more on the prepayment penalties. What are the prepayment penalties on this?
Yep. So most of them are going to be, like say, a 5-year step down. So 5% of the principal balance in the first year, 4% in the second, 3% in the third, 2% in the fourth, and 1% in the final 5th year. Like I say, we have one particular product that will allow you to, for a rate adjustment, to go from a 5-year to a 1-year prepayment penalty. The rate adjustment is literally like less than a quarter of a point. So the increase in monthly payment is minimal. You won't even see it that much to go from 5 to 1. So, but yeah, pretty much that's how I set up.
what is the most common DSCR ratio you guys are seeing?
One.
One, I would say one.
All right. Let's see. That was too short of an answer. It didn't give me time to look for another question.
Yeah, I mean 1.3 is on the high side with our current outlets. The highest one we have would be like a 1.25 for certain products, but like everything else in the lending space, it's really a sliding scale. You know, if you get to those lower DSCRs, you're going to have higher fees, sometimes other requirements. If you got a strong 1.25 or a 1.3, you're just going to have a lot more flexibility, higher LTVs, and better price. So the stronger deal you get, the better overall loan you're going to
Okay, so basically a 1 would be break even.
Pretty
get.
much.
Yeah, one's break even.
Okay. All right, so keep that in mind, folks. Always want to play with your numbers. If you guys have any questions, like there's a lot, actually there's quite a few questions on here. And if we don't get to them, be sure to reach, you've got the contact information on the screen there. Wade and Ernest would be glad to help you with those questions if I don't get to them. So let's see. Okay, what kind of, some of these are pretty vague. What kind of cash flow can you expect utilizing a DSCR loan? I mean, if we're looking at a 1, there's really not any cash flow, but so you want to step up from there, right? And that would be based on the amount of the loan and the amount of rent. So am I right?
Yeah, as far as the expectations for cash flow on a DSCR loan, it's really not any different than it would be on a conventional loan. The only difference is that the interest rate may be a little bit higher, and you may have more fees more closing costs out of pocket. So with that, I guess my point would be that you shouldn't go into them expecting a lower cash flow. You just have to bake in different loan terms, right? You might be out of pocket more, or you might have a slightly higher interest rate that would impact your monthly cash flow. That's really it.
Thank you, guys. And that concludes our webinar. Thanks.
Thanks again, John. And if anybody wants to reach out to our staff, we're happy to chat with you on any questions you may have if they didn't get answered today. Once again, thanks for the opportunity. You guys have a great day.